Hello and welcome to Mastering Finance with Dean Tellone. I'm Dean Tellone, your host, and I'm glad you're joining me for episode 14. Today, we're doing something a little different. We're diving into a glossary of finance, a rundown of key financial terms you need to know to navigate the money world with confidence. I'll walk you through more than 30 financial terms, grouped into categories like personal finance basics, banking, credit and debt, investing, taxes, and retirement. For each term, I'll give you a clear, simple definition and a real-world example so it really sinks in. Whether you're new to finance or just want a refresher, this episode will be a handy reference you can revisit anytime to brush up on your financial vocabulary. So grab a coffee, get comfortable, and let's demystify some financial jargon together. Let's start with the basics and build up from there. Personal finance basics. First, let's cover some personal finance basics. These are foundational concepts for managing your money day to day and planning for a secure future. Budget. A budget is a plan for how you will spend and save your money over a certain period, often monthly. It helps you allocate your income toward expenses, savings, and goals so you don't overspend. For example, you might budget $2,000 of your monthly income for rent and bills, $500 for groceries and gas, $300 for entertainment, and $200 for savings. By writing down these limits, you know exactly where your money is going and can adjust if you spend too much in one category. Cash flow. Cash flow refers to the money coming in and going out of your finances. Positive cash flow means you have more money entering income than leaving expenses, while negative cash flow means you're spending more than you earn. For instance, if you earn $3,000 in a month and your total expenses are $2,500, you have a positive cash flow of $500 left over. That extra cash can be saved or invested. But if you spend $3,200 on a $3,000 income, you'd have a $200 shortfall, negative cash flow, which isn't sustainable long term. Monitoring your cash flow helps ensure you live within your means. Emergency fund. An emergency fund is money set aside specifically for urgent, unexpected expenses or financial emergencies. This is your safety net for life's surprises. For example, if your car suddenly needs a $1,000 repair, or you face an unexpected medical bill, you can use your emergency fund to cover it instead of going into debt. Financial advisors often recommend saving enough to cover 3 to 6 months of living expenses in your emergency fund. This way, if you lose your job or have a major surprise expense, you have funds available to stay afloat. Asset. An asset is anything you own that has monetary value. In other words, it's something that can be converted into cash or that adds to your wealth. For example, assets include cash in your bank account, your car, your home, investments like stocks or bonds, and even personal items that could be sold for money. If you have a laptop or a piece of jewelry that could be sold, those are assets too. Assets are the things on the positive side of your personal balance sheet. They contribute to your net worth. Liability. A liability is the opposite of an asset. It's a debt or obligation you owe to someone else. Liabilities take money out of your pocket over time. For instance, a student loan, a car loan, credit card debt, or a mortgage, home loan are all liabilities. If you borrowed $10,000, that loan is a liability because you must pay it back. Liabilities are on the negative side of your personal balance sheet since they represent money you owe. Reducing liabilities by paying off debt will improve your overall financial health. Net worth. Net worth is a snapshot of your overall financial health, calculated as your total assets minus your total liabilities. It represents how much you'd have left if you sold everything you own and paid off all your debts. For example, if you own assets worth $100,000, say a house, car, and savings, and you owe $60,000 in loans and other debts, your net worth is $40,000, $100,000 minus $60,000. A positive net worth means you own more than you owe, which is a good sign. If your liabilities exceed your assets, you'd have a negative net worth, meaning you owe more than you own. Tracking net worth over time is a great way to measure progress in building wealth. Inflation. Inflation is the general rise in prices of goods and services over time, which reduces the purchasing power of money. In simpler terms, inflation means your money buys a little less each year. For example, if a loaf of bread cost $2 a few years ago, but costs $2.50 today, that's inflation at work. A more everyday example, if you keep $100 under your mattress, in 10 years you might still have $100, but it will likely buy fewer groceries or gasoline than it does today because prices have gone up. Most countries have some inflation each year, so it's important to invest or earn interest on your savings to help your money grow and keep up with rising prices. Now that we've covered the fundamentals of personal finance, let's take a closer look at how banks and banking products work. Banking terms. Banks are where many of us manage our money for everyday use and savings. Understanding banking terms will help you handle your daily finances and make the most of your accounts. Here are some common banking terms. Checking account. A checking account is a bank account for everyday transactions and spending. You use it to deposit your paycheck and pay for regular expenses. Checking accounts usually come with a debit card and/or checks, so you can easily access your money. For example, you might have your salary deposited into your checking account, then use that account to pay your rent, utility bills, buy groceries, or withdraw cash from the ATM. Checking accounts are very convenient for frequent use, though they typically pay little or no interest on your balance. They're primarily for access, not growth. Savings account. A savings account is a bank account designed for saving money over longer periods, and it usually earns interest on the money you keep there. People use savings accounts to set aside money for future goals or emergencies. For instance, you might keep your emergency fund or vacation fund in a savings account. The bank will pay you a small amount of interest, say 1% annually, on your savings. That means if you have $1,000 in the account all year, you'd earn about $10 in interest by the end of the year. Savings accounts often limit how often you can withdraw money to encourage saving, but they are a safe place to store cash while earning a bit of growth. Interest rate. An interest rate is the percentage that a lender charges you to borrow money, or the percentage a bank pays you on your savings. It's essentially the cost of money. For example, if you take out a $1,000 loan at a 5% annual interest rate, you'll owe an extra $50 in interest after 1 year, 5% of $1,000. On the flip side, if you put $1,000 in a savings account at a 2% interest rate, you'll earn $20 in interest after 1 year. The higher the interest rate on a loan, the more expensive it is to borrow, you pay more back. The higher the interest rate on a savings or investment, the more your money grows. Interest rates are often quoted annually per year. Compound interest. Compound interest is the powerful effect of earning interest on interest. This means that not only does your original money, principal, earn interest, but the interest itself earns additional interest over time. It can make your savings grow faster. For example, say you deposit $1,000 into a savings account with a 5% annual interest rate. After 1 year, you'd earn $50 in interest, bringing your balance to $1,050. In the second year, you earn 5% on $1,050, not just on the original $1,000, which is about $52.50, growing your balance to roughly $1,102. After the third year, you'd earn interest on $1,102, and so on. Over many years, this interest on interest effect can turn even small regular savings into a much larger amount. Compound interest is often called the snowball effect for your money. The longer the time period and the higher the interest rate, the more compound interest works in your favor. Certificate of Deposit, CD. A certificate of deposit, or CD, is a savings product offered by banks where you agree to lock in your money for a fixed period of time, such as 6 months, 1 year, 5 years, etc., in exchange for a higher interest rate. It's like a time capsule for your savings. For instance, you might put $5,000 into a 1-year CD that pays 3% interest. During that 1 year, you generally cannot withdraw the money without paying a penalty. In return for leaving your money untouched, the bank pays you a higher interest rate than a regular savings account. So after 1 year, your $5,000 would earn $150 in interest at 3%, giving you $5,150 back. CDs are useful when you know you won't need a chunk of money for a while and want to earn more interest than a normal savings account. Just remember, the trade-off for that higher interest is less flexibility. Your money is locked in for the term of the CD. FDIC insurance. FDIC insurance refers to the protection provided by the Federal Deposit Insurance Corporation in the United States for bank deposits. In simple terms, it's a government guarantee that your money in the bank is safe up to a certain amount, even if the bank were to fail. In the U.S., FDIC insurance typically covers up to $250,000 per depositor per bank. For example, if you have $10,000 in a checking account at an FDIC-insured bank and the bank suddenly goes out of business, the government, through the FDIC, will reimburse you that $10,000 so you don't lose your money. This insurance applies to checking, savings, CDs, and other deposit accounts. It's a safety net that ensures people don't lose their life savings due to a bank collapse. Credit unions have similar protection through the NCUA. Knowing your bank deposits are FDIC insured can give you peace of mind that your money is secure in the bank up to the insured limit. Now that we've talked about saving and banking, let's move on to credit and debt, terms that come into play when you're borrowing money or using credit cards. Credit and debt terms. Understanding. Credit and debt is crucial because they can help you achieve goals, like buying a home or car, but if mismanaged, they can also lead to financial trouble. Let's clarify some key terms related to borrowing money and credit. Credit score. A credit score is a numerical rating of your credit worthiness, basically how reliable you are at paying back money you borrow. It's like a grade for your financial trustworthiness. Credit scores typically range from about 300, very poor, to 850, excellent, in the US. For example, a high credit score, let's say 750 or above, suggests you have a history of paying your bills on time and not taking on more debt than you can handle. So lenders will be more willing to give you a loan or credit card at a favorable interest rate. A low credit score, say 600, means you've had some problems like late payments or high debts, and lenders might deny your application or charge you higher interest to compensate for the risk. In short, your credit score is a key number that banks, credit card companies, and even landlords look at to decide if they trust you financially. Credit report. A credit report is a detailed record of your credit history. Think of it as your financial report card or resume. It lists all your credit accounts, like loans, credit cards, mortgages, and details how you've managed them, including your outstanding balances, your payment history, on time or late payments, and any negative marks like accounts in collection or bankruptcies. For instance, your credit report might show that you have a Visa credit card with a $5,000 limit and a current balance of $1,200, a car loan with $8,000 left to pay, and 2 past loans that you paid off. Lenders review your credit report when you apply for new credit to see your track record. It's important for you to check your credit reports. You can usually get them annually for free to ensure there are no errors and to understand what lenders see about your financial history. Credit card. A credit card is a card issued by a bank or financial company that lets you borrow money for purchases up to an approved limit. It's a very convenient tool. You can buy something now and pay for it later. However, whatever you charge to the card, you'll need to pay back to the credit card company. If you pay the full amount you owe each month by the due date, you typically won't be charged interest. If you carry a balance, meaning you don't pay it all off, you'll have to pay interest on the remaining amount. For example, imagine you use a credit card to buy a $500 laptop. When your bill comes, if you pay the entire $500, you're done. You've essentially gotten a short-term loan for free since you paid it within the grace period. But if you only pay $100 and carry over $400 to the next month, that $400 will accrue interest. And most credit cards have high interest rates, often 15 to 20% or more annually. Over time, if you only pay minimum amounts, that $500 laptop could cost you much more due to interest. Credit cards often offer perks, like cashback or airline miles, which is great if you use them responsibly. The key is to not spend more than you can pay off to avoid falling into debt. Annual percentage rate, APR. APR stands for annual percentage rate, and it's the yearly cost of borrowing money expressed as a percentage. The APR includes the interest rate and any associated fees, giving you the true annual cost of a loan or credit. For credit cards and loans, APR is a useful number for comparing how expensive one credit option is versus another. For example, if one credit card has an APR of 18% and another has 12%, the 12% APR card is cheaper to carry a balance on. It will accrue less interest on any debt you owe. If you have a $1,000 balance on a card with 18% APR, in a year it could rack up roughly $180 in interest if unpaid. The same $1,000 on a 12% APR card would accrue about $120 in interest over a year. For a mortgage or car loan, the APR might include the interest plus loan origination fees or points. Bottom line, when you see APR, think total yearly interest cost. Mortgage. A mortgage is a specific type of loan used to buy real estate, most commonly a home. It's a large loan that is secured by the property itself, meaning the house is collateral for the loan. Mortgages are typically long-term, often 15 or 30 years, and you repay them in monthly installments. For example, if you purchase a house for $300,000, you might pay a 20% down payment, $60,000 of your own money up front, and take a mortgage for the remaining $240,000. The mortgage might have an interest rate, say 4% per year, and you'll pay the lender every month. A payment includes some of the $240,000 principal plus interest. If you fail to make payments, the lender has the right to foreclose on the house, meaning they take ownership of the property to recoup their money, because the house was the collateral. Mortgages make it possible for people to buy homes without having the full price in cash, by borrowing and paying overtime. Common types of mortgages include fixed rate, where the interest rate stays the same, and adjustable rate, where the rate can change after a few years. Principal. Principal is the original sum of money borrowed in a loan, or the amount of the loan that you still owe, excluding interest. In other words, it's the base amount of your debt. For instance, if you take out a $10,000 personal loan, your starting principal is $10,000. Each payment you make will typically include some interest and some reduction of that principal. So after a year of payments, you might have reduced the principal to $8,000. That's the remaining amount of the original loan that you still need to pay back. When you hear paying down the principal, it means reducing the actual loan amount, not just paying the interest. For a mortgage or any loan, in the early years, a larger portion of your monthly payment goes to interest and a smaller portion to principal. Later on, more goes to principal. If you pay extra toward your loan, that extra amount usually goes directly toward reducing the principal, which in turn reduces how much interest you'll pay in the future, because interest is calculated on the remaining principal. Collateral. Collateral is an asset or property that you pledge to a lender as security for a loan. If you fail to repay the loan, the lender can take the collateral as compensation. It's basically a way for a lender to reduce their risk. For example, when you take a car loan, the car itself is collateral. If you stop making payments, the lender can repossess the car. In a mortgage, the house is the collateral. If the homeowner doesn't pay, the bank can foreclose on the house. Some loans are secured loans, meaning they require collateral, like a house, car, or savings account, and these typically have lower interest rates because there's less risk to the lender. Other loans are unsecured, like most credit cards or personal loans that don't require you to pledge an asset. These often have higher interest rates because the lender is taking more risk. Nothing specific to claim if you default apart from potentially sending your account to collections or suing for repayment. In summary, collateral is something valuable you risk losing if you don't pay back the loan, so it motivates you to repay, and it gives the lender a way to get their money back if things go south. Great, now we've got a handle on credit and debt. Next, let's move into the world of investing, where you put your money to work to grow over time. Investing terms. Investing is all about making your money grow by putting it into assets that can increase in value or produce income. It comes with its own set of terms and concepts. Let's demystify some common investing terms. Stock, a stock, also called a share, represents a piece of ownership in a company. When you buy stock in a company, you become a shareholder, which means you own a small part of that business. For example, if you buy 10 shares of Apple, you literally own a tiny fraction of Apple Inc. If the company does well and its value goes up, the price of your stock might rise. So you could sell those 10 shares later for more money than you paid, making a profit. Some stocks also pay dividends. We'll talk about dividends in a moment, which are like profit-sharing payouts. However, stocks can also go down in value. If Apple hits a rough patch and the stock price drops below what you paid, your investment is worth less. Stocks are one of the most common ways to invest for long-term growth, but they come with risk because their prices can fluctuate day to day based on company performance and market conditions. Bond. A bond is essentially a loan that you give to a government or a company. In return, they promise to pay you interest and repay the principal on a specific date. Think of it this way. When governments or corporations need to raise money, they can borrow from investors by issuing bonds. If you buy a bond, you're the lender. For example, suppose you buy a $1,000 bond from the government, often called a government bond or treasury bond, with a 5% annual interest rate and a 10-year term. This means you give the government $1,000 now, and they agree to pay you $50 in interest each year, 5% of $1,000, often paid in 2 installments every 6 months, and then after 10 years, they'll pay you back your $1,000. Bonds are generally considered safer investments than stocks because you know what return you'll get, the interest, and you get your money back at the end, assuming the issuer doesn't default. However, bonds usually offer lower potential returns than stocks. Many investors hold bonds as a way to have stable income and preserve capital, especially as they get closer to a goal like retirement. Mutual fund. A mutual fund is an investment fund managed by professionals that pools money from many people to invest in a collection of stocks, bonds, or other assets. When you buy a share of a mutual fund, you're indirectly buying tiny pieces of all the investments in that fund's portfolio. It's an easy way to get diversification, spreading your investments without having to buy dozens of individual stocks or bonds yourself. For example, you might invest $1,000 in a mutual fund that focuses on U.S. stocks. That fund might, in turn, own shares in 500 different companies. So your $1,000 is spread across all those companies according to the fund's strategy. If one company in the fund performs poorly, it's not a huge hit to your investment because it's just one slice of a much larger pie. Mutual funds are priced once a day at the end of the trading day, and you can typically buy or sell them through a brokerage or retirement account. They do charge fees, called an expense ratio, to pay the fund managers. Overall, mutual funds are a popular way for investors, especially beginners or those without the time to pick stocks, to invest broadly in the market. Exchange Traded Fund, ETF. An ETF is very similar to a mutual fund in that it can hold a basket of many stocks or bonds, giving you instant diversification. The key difference is that ETFs trade on a stock exchange, so you can buy or sell them just like you would a stock throughout the trading day. In fact, ETF stands for Exchange Traded Fund. For example, there are ETFs that track major market indexes. One common ETF is an S&P 500 ETF, which invests in the 500 companies of the S&P 500 index, a benchmark of the U.S. stock market. If you buy shares of that ETF, you're effectively investing in all 500 companies at once. Unlike mutual funds, whose price is set at the end of the day, an ETF's price fluctuates during the day. ETFs often have low fees and are tax efficient, which has made them very popular. You might choose an ETF if you want the benefits of a mutual fund, diversification, professional or automatic management, but want the flexibility to trade anytime or potentially lower fees. Diversification. Diversification is a strategy of spreading your investments across different assets to reduce risk. The classic saying is, don't put all your eggs in one basket. If that basket falls, all the eggs break at once. Similarly, if you invest all your money in one stock and that company has trouble, your portfolio could be badly hurt. By diversifying, you make sure that if one investment goes down, it hopefully won't drag down your entire portfolio. For example, let's say you have $10,000 to invest. Instead of buying $10,000 of one company's stock, you might choose to put $2,000 in a tech company, $2,000 in a healthcare company, $2,000 in an international stock fund, $2,000 in bonds, and $2,000 in a real estate fund. Now you're diversified across different companies, industries, and types of assets. If the tech stock has a bad year, some of your other investments, maybe the bonds or the healthcare stock, might do okay, balancing it out. Diversification doesn't guarantee against losses, but it can make your overall investment journey smoother. It's basically not betting everything on one outcome. Risk tolerance. Risk tolerance is the level of risk, uncertainty about losses, you're personally comfortable with when investing. It's about how much volatility, ups and downs in value, you can tolerate in exchange for potential higher returns. Everyone's risk tolerance is different, based on factors like your financial goals, your timeline, and your personality. For instance, if you're young and investing for a retirement that's 30 years away, you might have a higher risk tolerance. You can handle the market going up and down in the short term because you won't need the money for decades, and it has time to recover. That might lead you to invest more heavily in stocks, which are riskier but have higher growth potential. On the other hand, if seeing your investments drop 10% in a month would cause you to panic and sell, you have a lower risk tolerance, so you might prefer more stable investments like bonds or cash. As an example, say investor A and investor B both have $10,000. Investor A is fine if that $10,000 sometimes drops to $8,000 in a bad year, as long as it could grow much more over the long term. That's higher risk tolerance. Investor B would lose sleep if it dropped that much and would rather see slow, steady growth. That's lower risk tolerance. Knowing your risk tolerance helps you choose an investment mix that you're comfortable with so you can stay invested for the long run without panic. Dividend. A dividend is a portion of a company's profit that is paid out to shareholders, people who own the company's stock, usually on a regular schedule, like every quarter. Not all companies pay dividends, but many established profit-making companies do as a way to reward investors. It's basically a cash thank you for investing in the company. For example, if you own 100 shares of a company and it pays a quarterly dividend of 50 cents per share, you would receive $50 every 3 months because 100 times 50 cents equals $50. $50. You can pocket that money, or, as many people do, reinvest it to buy more shares of the stock. Dividends are a nice way to get income from your investments without having to sell your shares. Companies that pay dividends tend to be more mature companies. Think utilities, large consumer goods firms, etc. Growing companies, like many tech startups, often don't pay dividends. Instead, they reinvest profits back into the business. When you're evaluating stocks, looking at whether it pays a dividend and how much is one factor, especially if you're seeking income. Portfolio. A portfolio is the collection of all your investments in total. It's like your entire investment basket. Your portfolio might include stocks, bonds, mutual funds, ETFs, real estate, cash, or any other assets you own. When people talk about portfolio performance or portfolio allocation, they're referring to how the mix of all those investments is doing, or how it's divided among different types of investments. For example, you might say, my portfolio is 70% stocks, 20% bonds, and 10% cash, which describes the allocation of your investments. If someone is giving investment advice, they might say something like, make sure your portfolio is diversified, meaning don't have all your money in one type of investment. The idea of managing a portfolio is balancing risk and return across everything you own. Even if you only have a retirement account with a couple mutual funds, that's still your investment portfolio. As you accumulate more assets, keeping track of them as one portfolio helps you see the big picture of your financial situation. Capital gain. A capital gain is the profit you earn when you sell an investment for more than you paid for it. It's the positive difference between the selling price and the purchase price of an asset. For example, if you bought some stock for $1,000 last year and you sell it today for $1,500, you have a $500 capital gain. That's essentially $500 of profit in your pocket before any taxes. Capital gains aren't realized, meaning they're just on paper until you actually sell the asset. If your $1,000 investment in stock went up to $1,500 in value but you didn't sell it yet, it's an unrealized gain. It could go up or down tomorrow. Once you sell and lock in the profit, it becomes a realized capital gain. Capital gains can come from any asset: selling a house for more than you bought it, selling an old comic book or piece of art for a profit, etc. One thing to keep in mind: capital gains may be subject to capital gains tax, which is often lower if you held the asset for a longer term, more than a year, in many countries. We'll touch on that next in the tax section, because whenever you're investing, it's good to remember that Uncle Sam, or your local tax authority, might want a cut of those profits. Now that we've gone through investing basics, let's touch on something everyone loves to hate: taxes. Understanding tax terms can help you plan better and keep more of your money. Tax terms. Taxes are a part of financial life. While they can be complex, knowing a few basic tax terms will help you make sense of how taxes affect your income and investments. Here are some important tax terms. Income tax. Income tax is a tax on the money you earn, your income, which is paid to the government. Most countries have an income tax for individuals and businesses, and it's typically one of the main ways governments fund public services. If you have a job, you'll notice income tax coming out of each paycheck. For example, if you earn $50,000 in a year and your effective income tax rate is 20%, you'd owe about $10,000 in income taxes for that year. In practice, employers usually withhold taxes from your pay throughout the year and send that money to the government on your behalf. Then, around tax time, say April in the US, you file a tax return to calculate the exact amount you should have paid. If you overpaid through withholding, you get a refund. If you underpaid, you may owe more. Income tax can apply to wages, salaries, freelance earnings, and often other types of income like interest or dividends above certain thresholds. Tax bracket. A tax bracket refers to the range of income that is taxed at a particular rate in a progressive tax system. Many countries, like the US, use a progressive system, meaning that as your income increases, the additional income is taxed at higher rates. It's a common misconception that if you jump to a higher tax bracket, all your income is taxed at that higher rate. In reality, only the portion within that bracket is. For example, imagine a simple system. 10% tax on income from $0 to $20,000, and 20% tax on income from $20,001 to $50,000. If you earn $30,000, the first $20,000 of your income is taxed at 10%, and the remaining $10,000 is taxed at 20%. This would result in $2,000 plus $2,000 equals $4,000 in tax, which is effectively a 13.3% overall rate. You're in the 20% bracket for that top portion, but you didn't pay 20% on every dollar you earned. Knowing your tax brackets helps in understanding how a raise or extra income will be taxed. Only the part that falls into the higher bracket gets the higher rate. Tax brackets are usually adjusted each year for inflation and can change with new tax laws. Tax deduction. A tax deduction is an expense or allowance that you can subtract from your income before calculating your taxes owed. Deductions reduce your taxable income, the amount of income on which you actually pay tax. By lowering your taxable income, deductions can lower your overall tax bill. For instance, if you earned $50,000 this year and are eligible for a $5,000 deduction, your taxable income would drop to $45,000. If your tax rate is around 20%, that deduction might save you about $1,000 in taxes, because 20% of $5,000 is $1,000. Common deductions, depending on your country's tax rules, might include things like mortgage interest, charitable donations, certain medical expenses, or contributions to retirement accounts. There are also standard deductions, a fixed dollar amount you can deduct, which many people take, instead of itemizing individual expenses. The key point is, deductions help you by making some of your income non-taxable. Tax credit. A tax credit is even better than a deduction in many cases. It's a dollar-for-dollar reduction in your actual tax bill. Instead of lowering your taxable income, a credit directly cuts the amount of tax you owe. For example, suppose after calculating your income and deductions, you find you owe $3,000 in income tax. If you then qualify for a $500 tax credit, for instance, a credit for installing solar panels on your house or for childcare expenses, that credit directly reduces your tax bill to $2,500. Some common tax credits include credits for education, like the American Opportunity Credit in the US, child tax credits for parents, or credits for certain energy-efficient home improvements. Unlike a deduction which might save you a percentage of the amount spent, a credit gives you the full value back. Some credits are even refundable, meaning if the credit is more than the tax you owe, you could get the excess as a refund. In short, when it comes to lowering your tax, credits are king because they directly save you money, whereas deductions just reduce the amount of income that's taxed. Capital gains tax. Capital gains tax is the tax you pay on profits. Capital gains from selling investments or assets. We talked about capital gains earlier. That's the profit when you sell something for more than you paid. Governments typically want a share of that profit, which is where capital gains tax comes in. For example, if you bought stock for $1,000 and sold it later for $1,500, you realized a $500 capital gain. If the capital gains tax rate is 15%, you'd owe $75 in tax on that profit. Many tax systems have different rates for capital gains, depending on how long you held the asset. In the US, for instance, if you hold an investment for more than 1 year before selling, it's considered a long-term capital gain and often taxed at a lower rate, say 15%, than your regular income. If you sell within a year, it's a short-term capital gain and taxed like ordinary income, which could be a higher rate. Real estate, stocks, and other investments can all trigger capital gains taxes when sold at a profit. On the flip side, if you sell at a loss, you might be able to use that loss to offset gains for tax purposes. The key takeaway is that when you're investing, you should be aware that taxes will take a bite out of your profits, and planning when and how to sell can make a difference in how much tax you pay. We've covered the gamut from earning and saving to investing in taxes. Now, let's look at some retirement terms, which will help you plan for your financial future. Retirement terms. Planning for retirement is all about preparing for the day when you no longer work full-time, so you need to rely on savings and other income. Here are some common retirement-related terms that are important to understand. 401k. A 401k is a retirement savings plan offered by many employers in the U.S. It lets you save and invest part of your paycheck before taxes are taken out in a traditional 401k setup into a retirement account. The money in a 401k grows tax-deferred, meaning you don't pay taxes on the contributions or investment gains until you withdraw it in retirement. Many employers also match a portion of your contributions as a benefit, which is essentially free money toward your retirement. For example, you might decide to contribute 5% of your salary to your 401k each pay period. If you earn $50,000 a year, that's $2,500 a year going into your 401k. If your employer offers a 50% match up to 5%, they would add an extra $1,250, half of your $2,500. So a total of $3,750 goes into your account that year. That money can be invested in options provided by the plan, like mutual funds, maybe stock or bond funds. Over the years, thanks to your contributions, employer matches, and investment growth, compound interest at work, your 401k can grow into a substantial nest egg. Typically, you can't withdraw from a 401k without penalty until you're at least 59 and a half years old, with some exceptions, and at retirement, your withdrawals are taxed as regular income. The 401k is one of the most powerful tools for retirement saving, especially if you get an employer match. That's an immediate 50% or 100% return on your contribution, which you don't want to leave on the table. Individual retirement account, IRA. An IRA is a retirement savings account that you can open on your own, independent of an employer. It's another way to get tax advantages for retirement saving. There are two main types: traditional IRA, and Roth IRA. In a traditional IRA, you often get a tax deduction for the money you contribute, depending on your income and whether you have a 401k at work. And your contributions and investment earnings grow tax deferred until retirement. When you withdraw in retirement, those withdrawals are taxed as income. In a Roth IRA, it's the opposite. You contribute money that's already been taxed, no upfront deduction, but then the money grows tax-free, and qualified withdrawals in retirement are tax-free. For example, suppose you put $6,000 into a Roth IRA this year. You won't get a tax break now, but say over 30 years, that $6,000 grows to $60,000. When you retire and withdraw that $60,000, you pay no tax on it because you paid taxes up front on the $6,000 and the growth is untaxed. If instead you had a traditional IRA, you might deduct the $6,000 from your taxable income now, saving money on this year's taxes. But when you take out the $60,000 in retirement, it would be taxed as income. IRAs also have annual contribution limits. For instance, $6,500 per year for individuals under 50 in the U.S. as of 2025. IRAs are great if you don't have a 401k or even in addition to one to save extra. They also offer a lot of investment choices since you can typically open an IRA at a brokerage of your choice and invest in a wide range of stocks, bonds, funds, etc. Choosing between traditional and Roth often comes down to whether you prefer a tax break now or later. Many younger people with lower current incomes opt for Roth. Tax-free growth is very powerful long-term, while those who want the immediate deduction or expect to be in a lower tax bracket in retirement might choose traditional. Pension. A pension is a retirement plan that provides a guaranteed income stream to retired employees, typically for life. It's often referred to as a defined benefit plan because the benefit, the payment you receive, is defined usually by a formula, often based on your salary and years of service. Pensions used to be common in large companies and government jobs, though they're less common in the private sector now. For example, a pension plan might say that an employee will receive 2% of their final salary for each year they worked as an annual payment in retirement. So if someone worked 30 years and was earning $60,000 at retirement, they might get 2% times 30 years equals 60% of $60,000, which is $36,000 per year as a pension. This would usually be paid in monthly installments for the rest of the retiree's life, and sometimes with survivor benefits for a spouse. The key feature of a pension is that the employer, or pension fund, is responsible for investing the money and delivering the promised income, not the employee. This is different from a 401k or IRA, which are defined contribution plans where you, the individual, are responsible for saving enough and making the investments, and there's no guaranteed payout. It depends on how your investments perform. Pensions provide peace of mind because of that guarantee, but they require the company or government to manage funds well to meet those future obligations. Social Security. Social Security is a government-run program in the United States, and some other countries have similar schemes, that provides retirement benefits as well as disability and survivors benefits to individuals. During your working years, you and your employer pay Social Security taxes. You'll see it as a deduction on your paycheck. That money goes into the Social Security system. When you retire, the standard retirement age for full benefits is around 66 to 67 for most people currently, though you can start as early as 62 with reduced benefits. You become eligible to receive monthly Social Security payments. The amount you receive is based on your earnings history. Essentially, the more you earned and paid into the system over your career, the higher your benefit up to certain limits. For example, A person who worked 40 years at an average salary and paid into Social Security might receive, say, $1,500 per month in benefits upon retirement. Someone who earned more might get $2,500 a month. Someone who earned less might get $1,000. These numbers vary, but Social Security is designed to replace a portion of your pre-retirement income. It's often not enough to live on by itself, but it provides a base of income that, combined with personal savings and maybe a pension, helps support you in retirement. Social Security also has features like cost of living adjustments to partly keep up with inflation, and spousal benefits. It's essentially a social safety net to ensure the elderly and disabled and survivors of workers who passed away have some income. We've covered a lot of ground, from budgeting and banking basics to the ins and outs of credit, investing, taxes, and retirement planning. Think of this episode as a finance glossary you can return to whenever you encounter an unfamiliar term. I encourage you to revisit this episode or the show notes as a reference anytime you need a quick definition of a financial concept. The more you familiarize yourself with these terms, the more confident and empowered you'll be when making financial decisions. Remember, building financial literacy is a journey. Expanding your vocabulary is a big step toward mastering your money. Keep learning, stay curious, and don't hesitate to continue exploring new financial concepts beyond these. If you come across a term you don't know, look it up. Over time, those once confusing buzzwords will become part of your own knowledge base. Thank you for joining me today on Mastering Finance. I hope this glossary of key terms helps you feel more comfortable and informed in your financial life. If you found this helpful, feel free to share it with others or keep it bookmarked for future reference. As always, I'm here to break down the world of finance into clear, actionable insights. Until next time, this is Dean Tellone, wishing you financial success. Stay smart and take control of your financial future, one term and one episode at a time.